This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest monthly bonus podcast from the AJ Bell Money and Markets team, all about investment trusts. I'm Dan Coatsworth, and joining me is Laith Khalaf. Hi there, Laith.
Yeah, hi Dan. We've got a veritable feast of experts on this episode of the podcast, including the man running Fundsmith Small and Mid-Cap Investment Trust, that's called Smithson. The manager, Simon Barnard, will be on the show to give his insights into a wide range of investing matters.
Martin Gamble is on the show. He's going to be talking to Mark Boggett from Seraphim Space about why this investment trust is an alternative way to play the defence sector.
Yeah, Martin's also going to be debating Bill Ackman's Pershing Square holdings with Shares Magazine's Tom Sieber in this month's deep dive on investment trusts.
Now, if that's not whetted your appetite enough, we've got BlackRock American Investment Trust. Looks to be the first of its kind to kind of deploy what looks like AI in its stock selection process. So we'll be talking to the manager Muzo Kayacan and chairman David Barron about what exactly it's trying to do and what this means for investors. But before we get on to those interviews, I just wanted to go through a couple of questions from AJ Bell customers on investment trusts. Now, we recently ran a webinar all about investment trusts, and there was a question and answer session in it. We didn't have time to go through all the questions. So I did promise on that webinar, if anyone listened to this episode of the podcast, that we would pick up on some more of those questions. So, Laith, I think it's time for you to sit in your mastermind, iconic black chair, declare that your chosen topic is investment
Specialist
trust.
Subject to investment trust. Yeah, are you going to do the music? I need the drum roll. Yeah.
Yeah, I can't do the drum roll, but I've got 4 questions for you. They're nice and easy. Hopefully we can rattle through these in time. And I think if you go onto the AJ Bell website, there's the videos from all the stuff around that webinar should be on our website. But you know, someone asked this question, I think is an absolutely fair question. Can you actually buy an investment trust and hold it in a SIP, which is a self-invested personal pension, or even just an ISA?
Yeah, absolutely you can. A lot of people do that, of course, because of the tax benefits of both of those shelters. So, I mean, broadly speaking, what both of them provide you with is protection from income tax, which means that your dividends from your investment trusts, such as those that are paid, are not taxable, and also no capital gains tax as well. So any gains that you get, you can cash in the investment trust whenever, and you won't be liable to any tax on those. Now, if you hold investment trusts outside of a SIP or an ISA, then you are potentially liable to any dividends that are paid. Everyone has an allowance, an annual allowance that you are allowed to receive in dividends tax-free. That is only £500 a year. So anything above that from investment trusts, shares or funds, any dividends will be taxable. And for capital gains, when you sell your investments, you have an annual allowance of just £3,000. Now that's been cut from over £12,000 in recent years. So SIP and ISA is really valuable tax shelters, and very widely used by people investing in investment trusts.
Excellent. So I think a lot of people are interested in investment trusts, but we do get this question asked quite often from time to time, which is, you know, how much of your portfolio should you actually hold in investment trusts? So Laith, there's definitely not a straightforward answer to that one, is there?
I've got a very straightforward answer. Yeah, it's very helpful as well. The answer is anywhere between 0% and 100%.
Very helpful.
How's that? Am I winning mastermind yet? So I don't think there's a set figure. There's absolutely nothing wrong with running a portfolio which has no investment trust exposure, and there's nothing wrong with running a portfolio which has, is totally invested in investment trusts. I think, as we have discussed on the podcast before, the kind of structure of the investment that you're choosing, i.e. whether it's an investment trust or an open-ended fund, is secondary to other factors, most importantly the investment strategy of the vehicle and the charges attached to it. So, those are the things that are going to determine where you're investing. And, if there's a really good manager who's running an open-ended fund, then that's probably going to drive you towards that manager. If there's a really good manager running an investment trust, that's probably going to drive you towards that investment trust. Or, the competing strategies between two are going to attract you one way or another. I'd say there are probably some slight nuances with that. So for less liquid investments, investment trusts are probably the better vehicle. Because, as we saw with open-ended funds, you can get into issues where you have illiquid underlying holdings, like we had in the property sector, where funds actually had to suspend trading because they weren't able to meet withdrawals from investors. With investment trusts, because they're traded on the market, you don't have that issue. You might have a really wide discount, which we do have a lot for liquid investment trusts, illiquid underlyings at the moment in the investment trust space. So that's probably one area where you wouldn't be able to, or where you probably prefer to hold investment trusts. And the other thing, the big difference between the two, I'd suggest, is that open-ended funds, you have passive vehicles, whereas investment trusts are all active. So if you're a passive investor, then if you only want to invest passively, then investment trusts aren't for you. But I don't know, Dan, I tend to think investment trusts are probably a little bit more. You probably need a bit more investing experience to buy them, because they trade on the market. There are a little bit fewer more complications than open-ended funds, in that you've got that discount and premium mechanism, and also there's the fact that they can borrow to invest, so they're a bit riskier. But actually, I think they're really useful vehicles for people to be held alongside open-ended funds and individual shares. So there's a lot of options for people to build a portfolio exactly how they want to.
Absolutely. Next question is, how are investment trust charges calculated?
Most are calculated as a percentage of the net asset value. So the investment manager will take into account charges which are deemed to be operating and recurring, is the general phrase that's bandied around, which is a little bit subjective. So the things that are broadly included in that, the big one is the management fee that is paid to the investment manager. That is operational and recurring. So that will be a big one. Directors' fees and expenses, audit fees, fund administration fees, all of that stuff is included. What isn't included is any costs of trading. Also, performance fees generally aren't included in the ongoing charge figure, which is what most investors will see, and also loan interest not included in the ongoing charge figure. So the figure is historic, so it's calculated normally at least once a year, and it looks back over the previous year at the expenses, but it still should give you a good idea of what the cost of the trust will be in terms of a percentage of the net asset value.
Excellent. And just finally, do you think we're ever going to get to a point where we'll see a Bitcoin investment trust available in the UK?
Bitcoin investment trust. Okay. This harks back to Voltaire's question, doesn't it, Dan? I don't know if a Bitcoin investment trust didn't exist, would we have to create one? So the answer is probably not. I mean, we did have the Grayscale Investment Trust, which was a US trust a number of years ago, which actually converted into an ETF. And I think that's probably because the investment trust structure itself doesn't really lend itself probably to commodities, including Bitcoin in that as a sort of pseudo commodity, I guess. There are no gold investment trusts, for instance, or oil investment trusts. I think there are a couple of reasons for that. One is commercial. So why, if you're launching a Bitcoin fund, why wouldn't you do it as open-ended? So as an investment manager, you can keep taking on more and more money because it's really popular right now. Why would you limit yourself to a pool of assets? But also, I think if you launched a Bitcoin investment trust in the UK at the moment, I suspect it would be unbelievably popular. But that would, I suspect, mean that it moved to a massive premium to the actual underlying, and then you probably got issues around consumer duty and stuff like that. I don't know, but I think probably more likely than an investment trust is the possibility that we will get Bitcoin ETFs launching in the UK. So at the moment, they're only available to professional investors, but they've been approved by the SEC, the regulator in the US, and there's some very big Bitcoin ETFs over there at the moment. They've started to come across into Europe as well, and you can buy them in Europe. But the FCA has been, quite conservative, and for legitimate reasons, about allowing access to these vehicles for UK retail investors. So that's probably the key. But I think in terms of Bitcoin exposure, it will be ETFs that will probably be the vehicle rather than investment trusts that are used.
Perfect. Well, thanks, Laith. So just a reminder to anyone listening or watching this podcast, we'd love to hear any questions you've got about investment trusts so we can feature them on the future podcast. These investment trust podcasts typically come out on the first Monday of every month. Send us an email. So the address is podcast@ajbell.co.uk.
Great. Well, shall we have our first guest, Dan? You recently managed to grab some time with Simon Barnard from Smithson Investment Trust to discuss what's going on in the Fundsmith Equity Fund's little sister and where he's seeing opportunities at the moment. Let's hear what Simon had to say.
Well, I'm pleased to be joined by Simon Barnard, the fund manager at Smithson Investment Trust. So, Simon, great to see you. You're doing okay?
Very good. Thanks, Dan. Nice to see you as well.
Yeah, I think for anyone watching this or listening to it, perhaps if you're not familiar with Smithson, it's effectively sister fund to Fundsmith Equity. So Fundsmith invests in sort of bigger companies, and Smithson's there for the small and medium-sized ones. I think you've had a sort of a range of about 500 million to 15 billion market cap sort of target for looking for opportunities. But I did notice that you've sort of switched to focus perhaps to look at the lower end of that market cap range. Why have you sort of made that decision to go down that path?
Well, ultimately, Dan, we're looking to buy small companies that become big companies. And that's why quality and growth is so important to us in those companies, because obviously you're not going to get a small company growing into a big company if it doesn't have very strong competitive advantages and a long runway of growth. I mean, that's just fact. But the reason why we're focusing a little bit more on the smaller side is because, look, since we launched in 2018, the portfolio has been up every single year except one, which was 2022. But I have to say that last year was a little bit disappointing because we're only up by a little bit and behind the benchmark. So whenever something doesn't go to plan, we spend a bit of time trying to analyze exactly why and then what we can do about it. And what we realized when we looked at our performance last year was actually it wasn't stocks that went down that really hurt us more than any other year, but it was really a lack of big winners that drove our performance, or we needed to drive the performance. And looking at the past, when the portfolio has done really well, we've had big winners that have gone up multiple times over several years. And so we realized that focusing on the smaller end of the market, you probably have a higher statistical probability of, again, getting hold of more of those companies that are going to go up multiple times.
Yeah, I mean, you mentioned about quality stuff. I mean, you've got a bit sort of a quality bias. I think a lot of people sort of hold the view that actually, when we have uncertain market conditions, quality companies might be pretty good place. For example, they might have high profit margins, and I guess that might give them some wiggle room to deal with things like unexpected costs. But quality companies often trade on a high multiple of earnings. And I think in uncertain market conditions, there's quite a lot of investors aren't really prepared to pay a high multiple earnings. So we see derating in some of these stocks. And indeed, we have seen this in recent years. So what's your sort of view on dealing with the quality might look like it's the type of thing to be invested now versus dealing with sort of deratings?
Well, as ever, Dan, I think the devil is in the details. So first of all, it really depends on what is causing the uncertainty at the time. So if we take a year like 2022, where clearly the uncertainty was being caused by rising inflation, an increasing interest rate cycle, and I'd say the biggest uncertainty for the market at the time was how high those interest rates were going to go. Then, of course, when you've got longer duration assets like quality growth equities are longer duration than average, on higher ratings, then yes, those ratings got compressed in 2022. And funnily enough, that is quite different to the fundamentals that we were seeing at the time. So, for example, while our portfolio of long duration, small and mid cap underperformed the market, the fundamentals of our companies were actually very strong. Our companies grew their revenue on average by 14% that year. It was a good year for the companies themselves, but the ratings got compressed because of the environment. Now, if you take another example like this year, so clearly we have had a lot of uncertainty due to changes of policy coming from Washington. And yet our portfolio this year to date is up in a down market. I mean, we're very pleased with what's happened this year in terms of performance. And then again, I think you see different aspects coming to the fore. So in this case, in a world where people are now concerned about different things like slowing growth, it could well be the fact that our faster growing companies, as long as they can sustain that, become rarer in that environment and therefore worth more. Or secondly, our companies have very strong balance sheets. On average, our portfolio companies have net cash, which again, ironically, in an increasing interest environment like 2022, actually helped the fundamentals, but again, didn't help the ratings. But this year, again, has helped because in times of growth uncertainty or recession, dare I say, those companies with very strong balance sheets become more valuable than companies with stretched balance sheets, particularly those stretched balance sheet companies whose earnings are also going to be badly affected by a recession. So I think it depends on the actual environment and the uncertainty involved.
Yeah, I mean, you mentioned about what's going on in Washington. Obviously, people are worried that Trump's tariffs might sort of lead to a recession, not just in America, but other parts of the world. Smithson's portfolio has got quite big industrial exposure. So one would have thought heavily exposed to what's going on in the economy. Is that sort of trouble you at all? Do you think you might dial down that industrial sort of weighting?
Not really. I mean, first of all, we do have around 35% in industrials as defined by MSCI, but I would caution that that is a very blunt definition. And actually, there are a few businesses in there that you or I would never class as industrial. So, for example, Paycom Software is in there. That's an HR software company. Or Verisk, which is an insurance data business. I mean, neither of those I think we would typically class as industrial. And second, it also doesn't in any way tell you how economically cyclical or sensitive those companies are. So what if I tell you instead that I typically have about 25% of the portfolio in what I would deem as defensive style businesses? And actually, quite a few of those defensive style businesses are classed within industrials. I think the most typical one would be Rollins, which is a pest control company, which really does tend to grow revenue come rain or shine in terms of the economy. And yet, like I said, that's classed as industrials, but I wouldn't say it was cyclical.
I guess there's always going to be rats to catch, no matter what's going on with the economy.
Absolutely.
Yeah. What I mean, half of your portfolio sort of generates sales in the US. Again, where do you stand in terms of if Trump's tariffs backfire and the US sees a recession? Do you think that you've got a mixture of companies that would still do well, something like a Rollins, or do you actually have sort of more economically sensitive stuff in there as well?
I mean, we do have some economically sensitive stuff in there, but it's important. You pointed out we've got half the portfolio in the US. It's a very important market for us, and we cannot just ignore it. And we don't want to. So, I mean, we don't construct the portfolio in any reference to our index. But if I told you that our index accounts for about 60% of that is in the US, it just gives you an idea of the shape of the universe that we're dealing with. But fundamentally, the US is a very attractive, exciting market, particularly for smaller companies, because if you bear in mind that a lot of smaller companies are still very domestically focused, and that means that bearing in mind the US is the largest domestic market still in the world, it is very much easier for a lot of smaller companies based in the US to grow to a certain size simply because their domestic market is so big. And it's also a very dynamic place to do business, an easier place to do business than many parts of the world. And actually, we even say internally, there are still so many $5 billion businesses in the US that we've just never heard of. It's a very rich and fertile hunting ground. But let's talk about the US specifically for a minute in terms of economy. I mean, for me, it's still a big if whether it goes into recession. Of course, it's possible, but clearly the maximum point of concern and uncertainty around tariffs was on Liberation Day. And along with it was the maximum pessimism from the market around the outlook for the US and potential recession. Now, obviously, since then, we've had a relatively consistent stepping back from a lot of those policies to where we are now, which is primarily a 10% tariff on everything. And so with that stepping back of policies, we have seen the market pessimism also come back in turn. And I would say the prospects of recession also roll back in turn. So recession is far less likely today than it was at the beginning of April, not to say that it's not possible, just less likely. And I would say that when I talk to my companies, they say a 10% tariff is no problem. I mean, they've already put through a bit of price and what they call surcharges to their customers to offset for that. Bearing in mind, like I said earlier, our companies have very strong competitive advantages, which means they have pricing power. And that is shown up by their gross margins. On average, our companies have 65% gross margins. That compares to those in the broader market of about 35%. So they are very well positioned to weather this tariff environment. Of course, they are worried if you ask them about recession, but everyone is now tending to agree that recession is less likely now that those policies have been rolled back. And let's look at where we are currently in the US. I mean, unemployment is low. Personal consumption expenditure grew again in April after actually quite a strong March. We see inflation at 2.5% and trending down. And even shorter term measures on personal consumption has been looking better, even in the last couple of weeks. So I would say, even as we stand, it doesn't look that concerning about the US. So in general, we feel comfortable about our positioning.
Okay. I just wanted to sort of ask about a sort of a mantra that exists in Fundsmith, the asset management firm behind Smithson. Obviously, Fundsmith talks about don't overpay, do nothing. But I would just thought, I had a quick look at your portfolio. Recently, you made an investment in a company called Doximity. Trades on about 36 times forward earnings, and that which is not arguably a cheap rating at all. Some would say that's a really expensive rating. You also had 36% voluntary portfolio turnover in 24, 48% in 2022, which is again hardly what I would call do nothing. And that just seems like active portfolio management. So where do you stand now in terms of arguing don't overpay, do nothing? Is that just like a guide, but sometimes it won't always be that way? Or would you argue that Doximity, for example, is not expensive stock at all, and those 2 years I talked about were perhaps unusual years for you?
Well, we will never overpay. I mean, you could buy the best business in the world at an expensive price and you won't manage to make any money. So don't overpay, is a golden rule. Now, Doximity, yes, is on about 36 times or 2.5% free cash flow yield. But before you decide whether that rating is expensive or cheap, I need to tell you what you're getting for that. So Doximity is a very exciting company. It is a professional network or social network for doctors in the US. So it is by far the largest network of its kind. So it's got very strong network properties to that business, which is a very defensible competitive advantage. And it also has extremely specific targeting for its pharmaceutical advertisers, because when doctors sign up for this social network, they have to provide their credentials, which immediately gives Doximity all the information on that doctor's career, their publishing record, their current interest, their current practice. And so when Doximity's clients, which are drug advertisers or drug companies, want to advertise their drugs to specific doctors, they can pluck out precisely the individuals they want to target, which, as you might imagine, is extremely valuable. Now, over the last 5 years, Doximity has grown revenue at a compound rate of 40% per annum. And because it's a 90% gross margin business, being a primarily a data company, it has grown earnings at twice that rate. Now, I'm not going to say that it can continue that run rate for the next 5 years, but when I explain that over those 5 years, Doximity has only served one advert per doctor per month for each of its advertisers, you can see that there is an enormous runway of growth ahead, even if they just serve 2 adverts per month. And so the last quarter, they were still growing at about 20%, and we expect that they can continue that for some time to come, simply because they've got that long runway of growth. So again, we've got a business with very strong competitive advantages and a long runway of growth, which is exactly what we look for. And the rating today may look high relative to other businesses, but I think you get a lot for that rating. So we don't think that's expensive. Now, on the turnover side, yeah, I mean, I think we have had to accept that it is extremely difficult to maintain our strong performance over time and have next to no turnover. And that's for a couple of reasons, and specific to small and mid-cap. I think the first reason is with small companies, they do tend to change over time and sometimes quite rapidly. We've seen a couple of examples where, strong founder-led businesses can pivot their strategy almost overnight. We have one example with Massimo where suddenly the founder decided, and this is a US-based medical device company, the founder decided to buy a consumer audio business, which was very confusing for much of the market. It eventually transpired that the founder wanted to create consumer-focused medical devices and sell it through, consumer distribution like Best Buy and so on, and start competing with Apple. Well, we didn't think that was a particularly good idea for a small company like Massimo, so actually we felt we had to sell out of that. We had little choice. Second, I said we buy small companies that we expect to become large companies, and some of them have become large companies, and therefore we sold out of those. So Fortinet here is a good example. We bought that in 2020. It went up multiple times during our ownership, and we sold it at the end of last year. That is now an $80 billion company, and I think by any stretch cannot be described as a small and mid-cap company. The sad fact, thirdly, is that we may make some mistakes, and there have been a couple of companies where we have owned them and then come to realize that the prospects weren't as good as we originally thought. Now, clearly, it's much better to sell those and move on and redeploy shareholder capital in those opportunities that will do better, and that therefore causes some turnover too. And then finally, we also have to accept that small and mid-cap share prices can be quite volatile, and a lot more volatile than large caps, which is good and bad, obviously. We've had several examples where the companies we own have got so expensive that we simply couldn't justify the multiple anymore. And, a good example of that is last year we sold Technology One. That reached a free cash flow below 1 or a PE above 80 times. And even though that business was very strong, growing at 18% a year, very high margin, at that valuation, we just couldn't justify it anymore. So we sold for that reason. So these are all very good reasons to create turnover, but we have realized that we cannot run the portfolio, expect the same strong performance, and have no turnover.
Thanks again to Simon Barnard. Let's now put our suits on for a trip into outer space. Seraphim Space Investment Trust, pretty one-of-a-kind outfit in the investment trust arena. It invests in the theme of space exploration, but it also increasingly plays into one of the hottest trends on the market in recent times, and that's the defense sector. And Martin Gamble recently spoke to the manager, Mark Boggett, about how the trust has found itself in this position. So let's hear what he had to say.
So we are a space investor, but there are some key areas we don't invest into. So we don't invest into launch, we really don't want to compete against Elon and SpaceX and the other couple of hundred launch companies that have been created over the last decade. We don't invest into space travel or anything to do with the moon or Mars or any of these really exciting future areas, because there is no real commercial market for those companies at the moment. The end customer is government. We don't know if and when a commercial market will appear. So most of the stuff that we're actually investing into are companies that are terrestrial companies in terrestrial sectors that can use the new kind of capability that's being developed from space around communications, around Earth observation, to really enable their business, to address problems that they've got, to enable new solutions. And that is a multi-trillion-dollar market opportunity. And that's very much where we are focused for the trust.
Yeah. And perhaps to bring it to life, you could maybe showcase one of your largest holdings, just to give an idea of the growth rate you've seen, the revenues, where it's applying its intelligence, its business model, and that sort of thing, how you're scaling it up.
Yeah, sure. So we'll focus on our largest investment, which is a company called ISAI, over 20% of NAV. And what they've done is they've developed a miniaturized radar on a miniaturized satellite that they now operate from space. They've got 48 of them in their constellation. And what it enables them to be able to do is to look down from space and see Earth in 25 centimeter resolution. That means that they can see millimeter movement. And because of the properties of radar, it means that they can see day or night, and they can also work through any cloud or any type of weather. So what they're able to do with their current constellation is see every square meter of Earth every hour. And then they run change detection algorithms to determine how that square meter of Earth has changed. So there's massive applications in defense and military, and there's massive applications in commercial and in every industry you can think of, understanding how the world has changed in virtual millimeter movements hour by hour. And this company is also looking to effectively grow its constellation. So that hour will come down to half an hour, go down to 15 minutes, will go down to real time over time. And as it takes that journey, the data set becomes more and more relevant and valuable to a broader group of end markets. But space is very much a dual use market. That means that every company that we're investing into can serve the defense and military, but also from the same satellite with no change to any of the hardware or software or output. They can also provide services to every commercial market. And this is obviously very important at the moment, given all of the increasing spending that's going on around the world on the back of rapidly changing geopolitics. So this company has grown very rapidly. It's now the market leader of its kind in the world. It's got revenues and bookings in hundreds of millions of dollars. It employs about 750 people around the world. It's now EBITDA positive and is growing at breakneck speed. And the area that it provides, which is Earth observation and very high detail capability in that, this is the exact area that Europe now needs, because we're now being able to be less reliant on the US as an ally and the capabilities that we've currently relied on from the US for decades. We've now got to wean ourselves off that rather quickly. And commercial companies like ISAI are going to play a really important role in enabling us to be able to do that.
Wow, sounds really interesting. And given the sort of parlor state of the IPO market, how close is the company to being, or what is the plan for the company? Do you want to keep it internally? Do you want to squeeze it for as much as you can, or do you want to list it?
So yes to all of those, really. So the company has gone through a process to get itself IPO ready, and that's been going on for a period of time. So the company believes that the public markets are the right place for it. Obviously, the market conditions are still not quite right at the moment to launch a company like this publicly, but we believe that the conditions are aligning. There are investors that want to get exposure to defense, and this is a very important company. It's a very important global company. It's a very important European company. So the company is very carefully working out when is the right time for them to come to the market. We've got 3 other companies in the portfolio that are doing exactly the same. One of them is already registered with the SEC of their intention to IPO this year. That company is called Voyager Space. So yes, the portfolio is really positioning themselves to get ready to go public. And then, of course, because of the New World Order, the huge amounts of defense budgets that are just being created across Europe in the last handful of weeks, we're talking, nearly $1 trillion or euros of new budgets for defense that have been created. So the market environment has changed, and we believe that these companies are also going to likely to become M&A targets. Defense is a very acquisitive market, and there's now very significant visibility on the customer side. The huge new budgets that are available to step in to provide capability around the gaps that are being left by the US. So these companies are going to be in demand to be acquired, and they are on the pathway to IPO. But because of world events, we can't really set any sort of timing on when this might be, other than they'll be doing it at the optimum time that they possibly can.
And I believe you have many large companies invested in the trust, or one of the vehicles that you have, so they can get an insight into the sort of cutting edge leading companies that are cropping up all over the place. Would you
That's
be
right.
would you be happy for them to be bought privately rather than taken public?
So yes, we would. Ultimately, we're in the business of investing into companies and then ultimately selling them to provide returns to our investors. But I would caveat that with the companies that are in the portfolio at the moment, particularly those that are focused for defense, which is the majority of the portfolio. They are very well positioned for how the market has changed. And I've gone on record a number of times saying that our top three companies in particular, we'd be quite disappointed if those companies got acquired during the course of 2025, because we believe that the longer term opportunity is going to take some time to come through, but that longer term opportunity is worth waiting for. These are companies that we believe are going to generate enterprise values in many billions. If you
Right.
take into account that SpaceX his valuation is $350 billion. We believe that some of the companies that we've got in the portfolio that are genuinely recognized as leaders within their particular fields of space, they have the potential and the market opportunities there for them to deliver against that, to become valued in billions of dollars and tens of billions of dollars during the course of the next handful of years. It's not inconceivable for some of these companies to reach a $50 billion enterprise value. So we would rather be along for the ride and be invested in these companies that have gone through an IPO process and then continue to hold them over the longer term in order to be able to provide those returns to our investors. And then the other point, just to finalize this, to help people understand, is that what we're really talking about here is performance that's being driven by defense. And the defense side is now really the most important market for these companies. But there's also the commercial markets as well. So they're going to act like a further sort of growth kicker further down the line, as these companies satisfy their customer needs in defense and do that during the course of the next few years. And then they've got time to sort of turn to the commercial opportunity. And of course, everything that they're doing, because these are dual use companies, all of the money that they're taking to develop their capability and deliver against those with customers, it all becomes even more relevant for commercial customers as well. So just the simple thing of growing the size of the constellation so that the data moves closer to real time just increases value and appetite from the commercial market. So there's this growth kicker that's inherently built in to all of the companies that we invest into.
Yeah. So in a sense, your worst nightmare is they get taken out too soon.
It is. It
Because
really is. It's
yeah,
perverse. It's perverse. There's one other thing I just wanted to make sure I got across,
of
Martin,
course.
to your listeners, which is that when we came into set up Seraphim and the focus that we had, we were really very much focused around space and how it's going to help humanity by delivering many sort of climate-related issues that the countries, the world has, and that we think that space is very well positioned to monitor and address some of these issues. So, monitoring everything that's going on Earth from a climate perspective, right the way through to providing solar farms in space that brings clean energy back to Earth. So, and we've got everything in between. What's happened because of geopolitical events is that defense has become the most important customer, and naturally these entrepreneurs have shifted their business to focus on this big opportunity. But we as an organization, we are only investing in the defense side of military. So we won't invest into the offense side of military. So what that basically means is that we prohibit ourselves from investing into companies who are looking to harm human life. So we're very much around the sort of the use cases that are providing intelligence and reconnaissance and security and defense rather than offense. So I just wanted to let folks know that this is a way of getting an exposure to this defense long-term growth theme, but they can do so comfortably in the knowledge that that doesn't involve us investing into companies that are autonomously killing people.
So thanks very much to Mark Boggett for coming on the podcast. It's now time for our regular deep dive into an investment trust. And this episode, we're going to be looking at everything to do with Bill Ackman, so the billionaire hedge fund manager, the man behind Pershing Square Holdings. So Bill Ackman's been in the news talking about desire to create a modern day version of Warren Buffett's Berkshire Hathaway business. So now with that in mind, we tasked Tom Sieber and Martin Gamble to get under the bonnet of what Ackman is up to and whether it can be achieved via Pershing Square Holdings or one of Ackman's other investment vehicles.
Billionaire investor and hedge fund manager Bill Ackman has forged a reputation over the years as a vocal agitator for change in the corporate world. And since 2017, UK investors have been able to invest in his Pershing Square closed-ended vehicle, which trades on the London Stock Exchange. Now, though, it seems Ackman is looking to potentially change tack, and he's expressed his hopes that he might be able to emulate the great Warren Buffett. So, Martin, could you explain just exactly what is going on here?
Yeah, hi, Tom. Sure. Well, it was announced, I think, shortly after the Buffett shareholder meeting, which he did attend, even though that he's not a shareholder in Berkshire. He did attend the meeting. And then shortly after that, he announced a purchase of half of the stock of Howard Hughes Holdings, which he's had a relationship with for many years, and he was the executive chair there between 2010 and 2014, I believe. So he had a shareholding in that business for a long time, but his idea is to build a mini Berkshire by using that as the vehicle. And he did it by purchasing 9 million shares at $100. So he spent $900 million he spent it at a premium. So he priced it $100, and the shares are still trading below that. So the market doesn't kind of believe there's a lot of value in it so far. But that's what he's done, and that money comes from not the Pershing Square vehicle that you mentioned, but from the management company. So the company that advises the vehicle. And that comes back from last year when he raised about $1 billion with institutional strategic investors, he called them, to potentially going public with his management vehicle in the future. But he raised roughly $1 billion. So that's where that money comes from. So it's not shareholders' money. It's his sort of private management company that's purchased this share. And his idea is, he's apparently always been an admirer of Buffett and his approach. Apparently the first book he read was The Intelligent Investor by Benjamin Graham, and he's followed Buffett ever since. So his idea is to do something similar by using Howard Hughes, which is primarily a property company, as the vehicle to make purchases of businesses which he believes are in his style of management, which is quality, durable businesses that have many years of growth in them. And so half of Howard Hughes will be managed the way it is right now as a property company, building communities. It's quite a big business, got about 12 billion of assets. And the other half of the business will be run by Pershing Square and the management team, looking for opportunities to build out some operating businesses. And for that, I think he's charging around $15 million a year. So he's taking fees from that, and then there'll be a performance fee on top.
I think that's really interesting. I mean, yeah, just to talk about, you obviously mentioned that that won't have anything to do with the actual Pershing Square vehicle that trades in London. But looking at that vehicle, so you mentioned the sort of types of companies that he typically invests in, and within that vehicle, there's normally somewhere around 8 to 12 core holdings, and they're large, liquids, typically North American companies. And like you said, the focus is on quality. He's looking at things where he thinks there's limited downsides. They generate lots of cash flow, and they do that reliably over time. And he does, as I said, he has had a reputation as a bit of a kind of agitator for change. And there are examples where he looks to kind of push for either management change or some kind of change in the operations or the kind of governance of a company. Looking at some of the kind of recent things he's been buying and selling, he recently sold his entire stake in Nike, and has opened a fairly significant position in Uber Technologies. So the company behind sort of the ride-hailing app, but also Uber Eats, etc. And he raised his holding in Hertz Global, but he sold, perhaps suggesting that he's a little bit kind of uncertain about the outlook for the US consumer. He sold his position, or some of his position, in Chipotle Mexican Grill and Hilton Hotels. Looking at how he's performed, if you look at it on kind of on an 8-year view, so sort of since 2017 when it listed, he has managed to beat the S&P 500, but I think there's a sense and an understanding that his strongest outperformance kind of came quite a long time before this vehicle was listed in the UK, so in the early 2000s. And another notable thing about the trust is it trades at a pretty significant discount to net asset value, so around 30%. It also has quite high charges, perhaps relative to other trusts, kind of around 1.5% with a performance fee on top. And I think that partly reflects the fact he, as well as investing in these sort of large liquid companies, he also invests in some slightly more kind of esoteric vehicles and also holds short positions.
Yes, I think historically he's run the hedge fund, so he's run a short book and a long book. He doesn't publicize these shorts these days, but he does. He has had a couple of successes since the time this trust's been listed. One was when COVID hit, and he decided to take a contrarian view that markets would bounce back by buying credit default swaps, and that worked out very well for him. And I think he made a few $1 billion of that. So he has this approach where if he thinks he's got a view which the market is missing, that is a profit opportunity, he will do a hedge overlay. So that comes on top of the stock picking skills that he's known for, and his activist approach, which he's known for. So he's got like three legs to his stool. So that's another differentiator for the trust, I think. I was just going to say, in terms of building this Berkshire vehicle, I mean, one of the key engines for Berkshire has been the insurance operations. They represent roughly half of the total assets of Berkshire today.
Yeah.
And they've been built up through what Buffett called the float. So the premiums that are paid out up front, you get access to those premiums before you have to pay out the claims and all the liabilities later down the line. And he's built that float into basically the engine of the company, because that provides the cash to invest in different companies. So the difference here is that Ackman hasn't yet got an insurance company, but he has talked about either buying one or building one from scratch, because he knows some people in the industry.
Okay.
So he's got that idea on his agenda, but there's nothing happening on it yet. And the other notable thing about Howard Hughes, and that will be run by the existing management team, by the way, they will focus on that property empire. And at the moment, it does generate cash, but it doesn't generate a lot of cash. And as they build out more infrastructure in these cities and towns that they're building, that consumes cash. So it's kind of the opposite to an insurance company. So he needs to find a solution to build. Otherwise, where's the cash going to come from to invest in these great businesses that he finds, or private businesses?
Yeah, absolutely.
So I think that's one of the challenges.
It's a really fair question. And presumably as well, if there was any kind of significant downturn in the property market, that could be a problem for this strategy, right?
Yeah, I mean, it could suck capital again out after the overall business. Yeah.
So yeah, I mean, it's, I guess, he sees the moment. He feels like it's kind of a timely point at which to be like, Warren Buffett is exiting the stage, enter Bill Ackman. But whether or not he can he can emulate Buffett, I mean, apart from anything else, he's doing it or attempting to do it in a very different environment from what Buffett, how Buffett built his success over decades.
Yeah, I mean, he did in an interview, I think with CNBC, he did mention that, the vehicle that Berkshire started with, which was the textile business, was a terrible business. And Buffett knew it was a terrible business, but he wanted to kind of use it for other purposes eventually. But and eventually closed that business in the 1980s. But he kept it for a long time, but it was a very difficult business. And Ackman said, well, actually, Howard Hughes is great business. He loves it. For him, it's a never sell business. He wants to hold it forever. So that's a slight difference, that he doesn't have the headwind of the textile business, which was in decline. But as you point out, it's a very cyclical business, and it does consume a lot of cash, and you do have downturns in the economy. So generally, Ackman's looking for businesses that can operate regardless of the state of the economy, that have durability, resilience, and growth. So Howard Hughes doesn't kind of fit that profile at all. But I'm sure he could sort it out, if he finds an insurance company or builds one from scratch. It's possible, but there's some of the challenges that face him, I think.
Yeah, 100%. And I mean, do we think it will have any major impacts, of either positive or negative, on the listed vehicle? I suppose, if he does become even higher profile, he's a relatively well-known name as it stands. But, if he was to reach the sort of name recognition of a Warren Buffett, I guess that might attract investors to the vehicle.
I guess it could, yeah. I mean, if people think that he's got the skills and he's on a roll, then that discount may narrow. How it actually plays out, because it's a separately owned vehicle.
Yeah.
Would those investors benefit to the same degree, unless he floated that at some point?
Yeah, and that's an interesting question. Obviously, last year he attempted to float a US closed-ended vehicle, didn't he? And then ended up sort of changing tack.
Yeah, and I guess the fact that the UK vehicle and the Dutch listed vehicle, which was available until recently, were both trading at big discounts, it kind of put a lot of investors off, because I think initially he wanted to raise $25 billion, and then he downgraded that to $2.5 billion, and then eventually just gave up on the whole thing. So he's had a few attempts at trying to create this sort of Berkshire vehicle in the past. Maybe third time will be a charm.
Thank you to Tom and Martin for that. Right, we've got time for one more segment, and it's a really interesting one. At the start of the show, we talked about BlackRock American Income Investment Trust turning to AI to look for investment opportunities. Bit of a dangerous one, I think, this one, Dan, for investment managers turning to AI. It's like, is your job going to be ultimately taken by the AI? Can you add value beyond talking to the AI? But to find out more, Dan recently caught up with the chairman of that trust, David Barron, and portfolio manager Muzo Kayacan to find out what's going on. Hope you enjoy this one.
So I'm very pleased to be joined by two chaps from the BlackRock American Income Trust. So we've got David Barron, who's the chairman, and Muzo Kayacan, who's a portfolio manager. So hello to you both. Thanks very much for coming on the podcast.
Thank you for having us.
Yeah, hello.
Well, great. The trust has gone through a sort of slight change recently. I wondered if we can sort of perhaps open up the conversation by explaining what you've been doing with your strategy, and perhaps just, is this a sort of a natural evolution, or was this actually in response to a period of underperformance and perhaps need to show shareholders that you're trying something new?
Shall I take that one? Yeah. So I think we looked at the trust, and we'd been having thoughts about this. And as you know, we had a continuation vote coming up, and we wanted to make sure that we went into that with a strong proposition for shareholders, something interesting for them. And I think there were three principal issues that the board was looking at. And the first was performance. The previous strategy had underperformed. The second was costs. and we wanted to deliver active US equity management at a lower fee. It's a competitive space. And we wanted something, and I think this is the most interesting thing, something that we thought could scale. So we wanted it to be bigger in shorthand. And these discussions went on over a period of time, and BlackRock put forward this proposal to us to change the strategy to the systematic strategy. I also would add we were very keen to keep the dividend. So historically, we had paid a dividend of 4%. We knew that shareholders valued the income, so we wanted to keep the dividend. And also, we wanted to keep, if you like, the value bias of the strategy. So a lot of the typical US equity funds benchmark against the S&P 500, which has its big constituents as many of those well-known tech names. And we'd historically invested in the value part of the market, and we wanted and had heard from shareholders that that was important to them. So, yes, clearly, back to your point, historic performance had been an issue, but I think this was very much in the board's mind about doing something positive, trying to find something innovative, and Muzo can talk about this shortly about how the strategy works, and something that's different. And this hasn't been done before in the investment trust market. And, it's perhaps this type of strategy is not as well known in the UK as it is in some other markets. So we were trying to be really on the front foot, something exciting, innovative, that was good value and had the potential to grow. And that was really where we came from. And, we got support from shareholders in the continuation. And I would also add, at the time of the continuation vote, we gave shareholders an opportunity to exit at asset value for 20% of their holding. And that was actually undersubscribed. So less shareholders took that up than could have done, which we think is also an endorsement that this is something that's got the potential to catch the imagination.
Okay. I mean, so you talk about the systematic active equity process. I mean, what's that in sort of plain English? Is this AI stock picking or something a little bit different?
Muzo, you should take that one.
Yes, AI. So I think it's worth taking a little bit of a step back, also emphasizing this is new to this particular investment trust. The team that I'm part of, the Systematic Active Equity team, we've been around for 40 years. So 40 years, we've been building and refining models to pick stocks. So then we come to this question, is it AI? Yeah, artificial intelligence, everyone's familiar with it now through tools like GPT. It's become very accessible. You type something in, you get something that looks conversational coming out. But really, if you take a step back, AI is about using algorithms, computer systems that take some information and then make decisions based on that information. And so 40 years ago, we were building simple quant models that would take some information, the price to earnings ratio, the price to book, and the dividend yield of stocks, ranking them and rating them, and then predicting which stocks would outperform or underperform. Fast forward to today, we just have much more data, more computing power. So these decision-making processes, these automated decision-making processes can be much more sophisticated. So now we have algorithms that can read 6,500 broker reports every day. And they've been trained on 27 million historical broker reports to identify what type of language in broker research does a good job of predicting stock returns. They can consume social media data. Is a company seeing more activity around its brand? And therefore, our research shows that tends to predict traffic to that company's website, which then predicts their revenues. So those are just a couple of examples. But again, coming back to this question, is it AI? It is a systematic process that takes data and makes decisions and predicts stock prices. But really, it's doing the same thing that even a fundamental investor would do. A fundamental investor would read the news, read the research, meet management, our algorithms read the transcripts of earnings calls, conversations between investors and management. So all investors are doing the same thing. They are all gathering information and then putting that information together and making decisions. We just use technology to do that in a systematic way.
So, I mean, could this process, obviously, it sounds like, you know, the initial phase of it's all pretty much run by computers, but do you think that you ever get to the point where actually they could, the computers could just then pick the stocks as well? Not wanting to put you out of a job, but do you think that there is a time that this is like a fund manager is not needed for this strategy?
And essentially what they are already doing is picking the stocks. It's the role of the portfolio manager to then oversee that process, and the role of our human researchers to oversee that process. Which data should we feed into the machine? So going back to this example of social media data, humans have done a lot of research on whether actually social media data does predict company fundamentals and stock prices. So it's the job of the people to decide what data to feed the machine. And then it's also our job, and this is something you see and you'll experience with AI tools. You can outsource the simple things to the computer or the AI, and the humans can think more creatively. So then, because we have this framework to say, okay, which data and in which combinations predict stock prices based on historical information, then the humans can say, okay, but history doesn't repeat itself. If we train a model over the last 10 years, that isn't necessarily going to be a perfect predictor of the factors that will really matter over the next 10 years. So I and other portfolio managers will then take these tools and tweak them. We'll say, can I find combinations of data? Can I build a model that actually works well in down markets as well as up markets? Because markets have mostly been going up over the next 10 years. That might not happen over the last 10 years. That might not happen over the next 10 years. Can I find data and signals that do a good job of predicting stock prices in value cycles versus growth cycles? And, you know, we've typically been in a growth cycle. So, again, on this point, if you can outsource the simple things to the technology, it frees up time for the humans to ask bigger, more creative questions and oversee the design of the algorithms in the machine, if you like.
Yeah, because I mean, the idea of using sort of computer program to whittle down the stock universe is not unique in the industry. I mean, Artemis has got a smart GARP tool, which is very popular. You know, it screens for opportunity. So, what makes your approach or your sort of capabilities a little bit different than everyone else?
Yeah, so to say there's a few things. So again, we've got a 40-year history of doing this. We've got a 40-year history of building and refining models, overseeing them through different market environments and crises. We also think more and more this is a scale game. So yes, we're new to the investment trust market. The systematic equity team at BlackRock manages over $240 billion in equity strategies. So we're larger ourselves than most asset managers. What that means is it gives us a big research and development budget and a big data budget. We have over 1,000 signals in our library, 1,000 different data sources that we've identified that predict stock prices. And we've also got a lot of people and a lot of infrastructure that we've built to identify how you put that data together, how you identify when a piece of data has lost its power. You know, if people stop using Instagram, you want to make sure that you've got new data feeding in and you've got the ability to make sure that your model starts to kick out that data. So just that experience of doing that.
I mean, so obviously now you've got this system in place. Have you sort of seen any surprises from the information it's giving you that perhaps you might not have thought about with what the previous process for the trust?
I mean, I'll just comment quickly on that. I mean, we've only been running this process for the trust now, maybe 6 weeks, a month, something like that. So I think probably it's better if Muzo answers that from the sort of longer term perspective, perhaps of working with this process over decades.
Yeah, absolutely. Again, when we now use machine learning, which sounds a little bit scary, but all it is a type of AI that that ideally it learns from the past, and it learns which combinations of data do a good job at predicting stock prices. So when we started to use this more extensively 10 or 15 years ago, there was a little bit of skepticism. Is this going to be a black box? Is it going to just load up on weird and wonderful things and identify that CEOs with a name that begin with a C, their companies tend to outperform? Actually, the big surprise for us as more sort of traditional quants who are more experienced in looking at individual data sources than making the decisions ourselves to blend it, the model, up and down the model, it just comes up with very reasonable things. When we trained algorithms to read quarterly earnings call transcripts and identify what language, what words were most powerful in predicting stock prices, it just came back and showed us that negative language is much more powerful, which makes total sense. If a CEO is on an earnings call, he just wants to be bullish. He wants to say everything is good. If he's forced to admit that there are challenges and problems and delays, then yes, that becomes very significant. And again, as we look on a bigger level, how did these algorithms blend lots of different data sources? They just come back with a very balanced model that considers the valuation, the quality and profitability, the management, the broker sentiment. It looks at who is trading stocks. Are they overbought because certain retail investors are overhyping a stock or people are crowding into it? So actually, the big surprise is that there are no surprises. The big surprise is that the model looks like what you would get to if a human being had infinite time to consider all of these different data sources and put them together. It all ends up being very balanced, but it's just the ideal combination of signals and data.
So I guess if you're able to sort of monitor the language in reports, this is a good way of working out which ones to avoid. Because I guess when people think about what fund managers do, a lot of it is about what to avoid as well as what to buy. I guess if that helps to narrow down the universe, or perhaps throws up a trigger for a stock that you already hold, would that be enough to go on? If you had a set of earnings reports that showed negative language, would that be a trigger for you to get out, or would you still want to see more information, more evidence down the line?
So the way that the models work is that they're always looking at a blend of different data sources. So I mentioned we have a library of around 1,000 signals. What then happens is the portfolio managers using these AI tools will end up with a model of more like 50 to 100 signals that work best for their market. So there's some data that is available or works better in the US that doesn't apply in emerging markets, and vice versa. And now in that model, so for example, in the investment trust where we're looking at 50 to 100 data sources that predict US stock prices, the model view will be an aggregation of all of those different data sources. So the model will be saying, is the stock expensive or cheap? Is it profitable? Are employees happy? Does it have a moat?
Yeah.
It will be looking at the text analysis of the broker reports and the earnings call transcripts, and it will look at who is trading. Is a hedge fund shorting the stock? Are retail investors buying it? Now, because you're combining lots of different data sources, the model will only be very bullish on a stock if it scores positively on lots of things. It will only be very bearish on a stock if it scores negatively on lots of things. Now, if one score changes, that might not be enough to shift everything. What ultimately the model is looking for is confirmation. Are there 20 reasons to be underweight this stock or 50 reasons to be overweight it? And that guards also against problems. Maybe there's one piece of data that isn't quite right, or the algorithm didn't quite read this particular broker report properly. You guard against problems there because you combine huge numbers of data sources to give you greater confidence in that prediction.
Great. Well, David and Muzo, thank you ever so much for coming on, talking about BlackRock American Income Trust. It's been fascinating to hear about what you're up to.
Thank you very much. Thank you for having us.
Great. Excellent.
Thanks for the time. Thanks for the great questions.
Thank you again to David Barron and Muzo Kayacan. Now, that's all we have time for on this episode of the podcast. The normal AJ Bell Money and Markets podcast will return later this week. So until then, thank you very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.